Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Welcome back to Macro Minutes, the monthly emerging markets edition. I'm Abbas, Keshvani, your host for today. We are recording this episode on May 27th and May 28th, 2026. Joining me are Luis Estrada, our Latam FX strategist, and Daria Parkhomenko, our EMEA FX strategist. Folks, we have seen this episode before. We are currently digesting the prospect of a potential resolution to the war between the US and Iran, but it is worth noting that we have seen this episode before. I risk being a party pooper, but I'm counting the number of periods during which we've had the prospect of a deal dangled before us, and I'm counting no fewer than 8 episodes where the two belligerents have talked about a deal or we've had some kind of temporary ceasefire. And in all of these episodes, what happens is that we see the oil-sensitive currencies, which is your currencies that tend to import oil. So we're talking the Korean won, the Thai baht, Turkish lira. All of these guys will tend to rally. Hooray, it looks like it's the end of the war. And then a week later, sometimes sooner, all of the gains are given up and actually they're weaker than they were before. So we have seen this episode. It is important to check our exuberance and wait for more details before we start loading up on risk. Having said that, just because we are in a state of limbo, and I think we can call it limbo, that doesn't mean that we have to twiddle our thumbs. We do have a wartime playbook about how we're thinking about FX. And for investors who are wary of the vacillating news flow, we do see value in being oil neutral. And that's to say, there's a lot of currencies in EM, especially currencies in Asia, that are sensitive to higher oil prices. And there's no shortage of RV trades one can do, basically playing one oil importer against another. That allows you to basically neutralize a lot of your energy exposure, a lot of your war exposure. And that's certainly how we think one should bide one's time until we get a firmer resolution to the war. So we did this recently in the form of a bullish Korean won expression versus other Asian currencies that are sensitive to oil prices and inflation. We'll talk about why the Korean won trade hasn't worked out in a little bit, but the playbook, I think, still stays the same, which is, looking at things from an RV perspective while the war is raging. All right. What do we do when the war ends? Because we also have to have a view on a post-war world, and that world looks a lot better for EMFX. We particularly like a lot of the currencies that have been battered by the war because we think their prospects will improve significantly. In Asia, there are opportunities in the Korean won and the Thai baht. Both these guys have taken it very hard from the onerous oil imports that they have to do. So there's a lot of strength that we could see coming up ahead if the war were to abate. In LATAM, we've already entered a short CAD CLP recommendation because we're expecting an unwinding of long or bearish CLP hedges. And also, remember, Chile has positive exposure to higher copper prices. So we actually already do have a trade to position for a post-war world, and we're looking to add more once we get confirmation of some good headlines.
Abbas, we have been talking about the prospects for fiscal stimulus out of China. Why do you think it is imminent now?
Well, Luis, the meeting between Trump and Xi that took place in May was very interesting because it was the culmination of a very long, drawn-out trade war. You see, for a long time, China was not in a position to prepare for its own domestic economy's needs, and they certainly couldn't announce any kind of meaningful fiscal stimulus to shore up growth. But now that Trump and Xi have shaken hands, and at least it appears to be the case that now they're moving on to other pressing matters, including the war in Iran. China's finally in a position to think about domestic concerns, and we do think in the coming weeks and months they will finally announce some kind of fiscal stimulus. Keep in mind, they already did some of that in March following the NPC. So they already announced some stimulus. It was not a bazooka. We don't think it's going to be a bazooka even going forward. But the point is, we should expect more stimulus. And when that comes in, it would boost the cyclical narrative for China. It would lead to the next leg of downside in dollar CNH, and we are, of course, still bullish CNH versus dollars and euros equally weighted. Having said that, look, if we get a disappointment from Beijing, if they don't really announce fiscal stimulus, well, it's important to note that policymakers do have a revealed preference for a stable or maybe even slightly stronger currency. So based on that, we should still expect CNH to perform relatively well, and we're happy keeping this trade on. I will say, though, and this is just me talking about sort of risks to the view, it is notable that the EU is becoming increasingly vocal. We've been hearing about potential upcoming protectionist measures from the EU. If that were to be formalized, if they were to actually erect barriers to Chinese exports, then there would be less of an impetus for the PBOC to keep fixing CNH stronger. So that is a risk to the view. But barring that, I do think we are in store for some solid performance for the CNH up ahead.
Abbas, what ails the Korean won? How does the currency sell off when its stocks and exports are booming?
Great question, Dasha. And it has been frustrating to see the won perform so poorly, given that Korea has everything on its side, ostensibly. It's got a solid trade surplus. It's got inflows into its bonds because of the WIGB inclusion that's taking place and will take place all the way through to November. And also one of the biggest drags, which is retail outflows into foreign stocks, have abated. So on the back of that, one should expect the Korean won to get stronger. And yet this is a currency that's taken it the last few weeks have been really hard on the Korean won. And this is because of equity outflows, sizable equity outflows from Korean stocks. And that's odd as well, because the Kospi is booming. It's pretty much doubled compared to 6 months ago. But that's precisely the problem, because you see a lot of people, a lot of portfolio managers, they're not going to increase their weight for Korea as quickly as Korea has outperformed the rest of the world. So a lot of folks find themselves inadvertently overweight Korean stocks. And as a result, they have to sell some of those Korean stocks. And as a result, those outflows have triggered one weakness. I don't think this is done yet. The size of the position reduction by portfolio managers we still need to see more trimming of Korean won stock exposure by portfolio managers to basically come back down to a normal weight, unless they're okay being overweight. But a lot of passive investors generally tend to follow the benchmark. So I do think we should expect more outflows. While that takes place, it's very difficult for us to turn bullish on the won. But once the rebalancing is complete, I think the Korean won dollar won should come back down. We should basically prepare ourselves for some pretty solid performance by the Korean won. And, we are looking to re-enter a bullish Korean won position. But like I said, one really needs to see the portfolio rebalancing complete before doing that. Let me flip this to you, Dasha. How are EMEA central banks reacting to the ongoing Iran conflict?
Thanks, Abbas. I think the main theme that is unfolding is a divergence in monetary policy across EMEA. Two central banks are in a cutting mode, two are effectively in a tightening mode, and two are somewhere in the middle, but probably closer to the latter than the former. On the cutting side, we have the Bank of Israel and the National Bank of Hungary. The Bank of Israel, they resumed cutting rates on Monday, May 25th, and more cuts are likely in the pipeline. But from a currency perspective, I don't think we're at the point where the cuts will reverse the downtrend in dollar shekel, especially as the governor's comments suggest the hurdle is high for FX intervention. And that means that monetary policy is not sufficient on its own to change the downtrend in dollar shekel. Now, for the National Bank of Hungary, momentum, I think, has been building towards a rate cut in June. They will likely start cutting rates then. And that is likely to happen as long as energy prices are well contained and the forint is not selling off. For the currency impact, similar to the shekel, I think cautious rate cuts are likely to only temper the forint's appreciation because the forint has been supported by market expectations of the EU funds being unlocked and progress being made on fiscal consolidation. Now, if we look at the other end of the spectrum on the tightening side, the Central Bank of Turkey, they delivered a backdoor rate hike when the Iran conflict first started. And then we have the South African Reserve Bank, which is likely to hike rates this Thursday, May 28th. Any further hikes from the SARB are likely to be gradual, but this is still in contrast to the cutting bias that we're seeing out of both Israel and likely to start in Hungary as of the June meeting in terms of the rate cuts. Now, in the middle, we have the Czech National Bank and the National Bank of Poland. The CNB, is not rushing to take action, but the signal from the central bank has been that they will not hesitate to react if necessary. And the governor said earlier this month that the bank will be discussing holding or raising rates at the next meeting. And similarly, from the National Bank of Poland's perspective, they have been on hold, and probably they will continue to be on hold in the short term, but we have seen a more hawkish tilt from that central bank. Previously, they were still keeping the door open to rate cuts, but now they're shifting more towards the hawkish side and suggesting that they could also potentially raise rates if necessary, if the inflation outlook suggests that they should.
We are now coming into the first round of the Colombian presidential elections. Luis, what are your thoughts on the outcome and the market implications of that outcome?
Good question, Abbas. The first round for the presidential elections will take place next Sunday, 31st. For a candidate to win, he or she needs more than 50% of the votes. There are three main candidates. In first place is the left-wing candidate, Iván Cepeda, who's representing President Petro, and whose Petro is very strongly campaigning for him. Cepeda is ahead on the polls. He has a weighted average of around 39% of vote intention, so he's only 11% away from being able to win the first round. His campaign has been focused on achieving this first round win, and we estimate that the possibility that this happens is around 30%. This outcome would guarantee extending Petro policies and a continued deterioration of Colombia fundamentals, so the market would really react negatively to this. We think that the copy would sell off around 12% from the current levels. This is 1.5 times the average sell-off that we have seen in recent years. The second candidate is a far-right high-profile lawyer, Abelardo de la Espriella. Abelardo branding has taken elements from Trump-style politics with an aggressive digital strategy and religious references. He polls strongest among older male voters, and he reflects his macho persona. That's why they like it. He's very likely to be the runner-up on the second round. He's polling around 30% of votes, but he has gained popularity at the expense of center-right candidate Paloma Valencia. She's a senator. She only polls around 18%. But going into second round, her role could be the most important factor for Abelardo to have a chance to beat Cepeda. The second factor would be if Cepeda has a lead versus Abelardo that is larger than 10% of the votes in the first round. This can very much demoralize Paloma's voters and make them feel closer to Cepeda. If we come out of the first round with a lead of 10% or more for Cepeda, we also think there will be a sell-off in the copy, probably between 5 and 7%, anticipating a victory for Cepeda in the second round. The third scenario is if Abelardo, or in some case Paloma, could go to the second round with a spread versus Cepeda that is less than 10%. If that happens, copy could advance slightly positive, 2 or 3% versus the dollar. Speaking of politics landscape, Dasha, there was a recent court ruling in Turkey that caused a negative reaction in Turkish assets. What happened? What does this mean for the lira?
That's a great question, Luis. So the quick recap of what happened is that there was a court ruling in Turkey last week that effectively removed the CHP's party leader and reinstated the party's previous leader who had lost to President Erdogan in the 2023 election. In terms of the market reaction, markets interpreted this ruling as weakening the main opposition party. And it has also raised the question in the market about whether Turkey may call snap elections. Now, if snap elections were to be called, TRY depreciation may initially accelerate on concerns about a dovish shift in the monetary policy stance ahead of elections. But my view is that I don't think a shift in the policy stance is going to be a given. I think that there will still be a focus on keeping monetary policy sufficiently tight to rein in inflation and temper the Turkish lira's depreciation versus the US dollar. Hence, for me, when I think about the currency impact, I think that dollar Turkey will continue to trend higher, but at a slower pace than what is being priced in by the forward curve.
Luis, how do you see the potential Strait of Hormuz reopening impacting LATAM assets?
That's a very interesting question, Abbas. We're observing a slow grind towards an Iran deal and an alignment of interests. I believe that the first currencies that would benefit from any kind of Iran deal are the ones that investors are shorting as macro hedges. This means they are hedging some assets by shorting these currencies. They're usually the low carry, oil imported currencies. Chilean peso is a perfect example. Dollar Chile is trading 2.2 standard deviations higher in positioning than what it usually is held by foreigners. So foreigners are very long dollar Chile. We believe they are hedging assets in the region by shorting this currency. And if they unwind this, then the Chilean currency is going to appreciate significantly. We recommend a tactical long Chile while shorting Canadian dollar to maximize the benefit of an Iran deal. As Dasha has written, the Canadian dollar has been a mini dollar and a safe haven of sorts. So these can add a bit of momentum to the trade. I think these kind of currencies are the ones that are going to be mostly affected. And in the case of Latin America, Abbas, certainly Chile is the one that I would look at first.
Luis, Dasha, thank you both for joining me on the show. To our listeners, thank you for tuning in. For additional insights, please reach out to us or your RBC sales representative. Be sure to join us next month as we continue navigating emerging markets together.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.